Well, we know that in the past, Africa wasn't very much a part of the American consciousness, and without that, there could be no interest. That was some of the commentary we had from former Clinton Treasury Secretary Bob Rubin, who was quoted back in 2008 as saying, if they understood it, there would certainly be appetite. With all the appetite we're seeing now, is there necessarily an understanding of African market dynamics as you see it?
There's certainly growing interest in Africa from both Europe and the United States, primarily because the sustained economic performance of the region is beginning to attract investor interest outside Africa. That interest is not yet translating into significant inflows, but I think that's just a matter of time. Eventually I would say that Africa would probably begin to sit comfortably in most emerging market portfolios, and it would have an allocation of its own. People are interested, people think they understand that there's change going on the continent, and they are looking for ways to access that change. What you sort of tend to find at the moment is that investors in Europe and the US try to play Africa through what I call a Diet Coke type of strategy, where you look for companies listed on European exchanges or US exchanges who have significant exposure to African markets. So companies like Unilever, Nestle, Guinness begin to look attractive because of their African businesses. But I think gradually, as time goes on, people will move from that that idea of looking for companies which are based in Europe, which have African exposure, to actually investing in Africa themselves. I mean, we saw the same trend with South Africa from 1994 until about 2000. A lot of South African investors looked for companies on the JSE that had African exposure. And now South African investors are very confident moving up and investing directly in African equities. I think we're going to see exactly the same trend happening in Europe and in the United States.
I asked about that understanding and appetite based on real understanding, because we're hearing murmurings of a risk aversion creeping in again as the US starts to publish better sets of numbers on both the economic and corporate ends of the spectrum. Surely this poses some threat in the form of strong capital outflows, or not really?
Oh no, it always does. I mean, investing in markets like Africa tends to be something that people do after they've already filled up their allocations in other regions. So investors in Europe and the US need to feel confident about the outlook for their own regions before they would consider significant allocations to Africa. So to the extent that investors are risk averse, we wouldn't see significant inflows. That's part of what has driven the differential in performance between Africa and most of the other global emerging markets since about 2008. We've not seen much new inflows coming into the continent. But what we've seen is growing interest. When we go marketing and when we go meeting investors, people are willing to listen. As I said, this is not yet translating into substantial new monies coming in, but in my view, that's just a matter of time. Eventually, the robust performance of the corporate sector and the robust performance of the economic of the macroeconomies in Africa will compel investors to take a stronger and more aggressive look at the region. But for the time being, while investors are risk averse, we will see marginal flows. That's not to be disappointed. That's not something that should be too concerning, because if we had significant strong flows, it could lead to asset bubbles. And I think gradual flows over a period of time is probably it's something that Africa will find easier to cope with.
Still, one of the big challenges for African stock markets is the paucity of listed companies and limited number of shares that are traded on a daily basis. How do you advise those offshore in terms of navigating around this persistent problem?
Even for those of us who are long-term African experts, that is our biggest problem, is liquidity and availability of investment opportunities. There's no magic bullet or magic solution to it. Investors have to decide which sectors they like, what investment themes they want to follow. And these days, there are a broad range of entry vehicles that you can use for gaining access to Africa, both beginning from private equity funds, or all the way to listed equity funds. So if if investors don't feel they have the confidence to be able to make the investment decisions themselves, they can subcontract. They can outsource it to professional fund managers, funds like ours. There are a whole range of funds that could offer investors options and opportunities into these markets. But again, this issue of liquidity, it's a temporal point. Liquidity in Africa, over my career and over my span of time of looking at these markets, have grown by almost tenfold. And I think if we were to look back again in about 5 years' time, we'll find that liquidity would have increased substantially again. So it's not a sufficient reason for not going into the continent, but it is a risk factor that investors have to be concerned about. And the main way of playing it would be to understand that when you invest in these markets, you invest for the medium to short term. You can't trade African equity markets. They don't have sufficient liquidity for allow you to adopt a trading strategy. But a long-term investment strategy can work. You can find good entry points and you can find good exit points.
For now, let's take a look at your two funds that you mentioned there, Duet Africa Index Fund and Duet Africa Opportunities Fund. What kind of performance filtered through in 2010, and are we seeing a rebalancing of your portfolios at this stage?
The Africa Opportunities Fund did very, very well. We were very satisfied with performance. We ended 2010, the fund was up 26%. The Victoire Index Fund also had credible performance. Its performance was up 10%. The index fund is, it's a passive tracker index, so we rebalance it according to index rules. There's very little manager discretion involved there. On the Opportunities Fund, we're beginning, we're taking profits in markets like, we're reducing our exposure to markets like Mauritius, we're reducing exposure to markets like Ghana, and we're also reducing our exposure in Kenya. Not because we don't like these markets, but because we think we see better opportunities in some of the other markets that have not yet received much attention over the last year. So the markets that we kind of like, our top pick in terms of markets this year is Zambia. And we continue to like Nigeria. We think the story for Nigerian banks still has a fair bit of room, and there's still a lot of headroom. And those banks will still, when all the AMCON issues are sorted out, I think Nigerian banks will. We remain optimistic that Nigerian banking sector will deliver outperformance.
Well, certainly with the Nigerian banking sector making 2/3 of that market, hard to ignore. Let's take a look at Zambia and some of the opportunities that you have found within that territory.
In Zambia, we like Zambian breweries. I think there's a restructuring story to be told for Zambian breweries, which is, it's one of the subsidiaries of SAB Miller. So, the corporate governance structure and the management structure of the company is extremely sound. I think the reduction in excise duties will help their beer volumes, and we see quite good, strong growth there. CEC, the Copper Belt Company, we think I think for this year we are optimistic on commodities generally, and we think that copper prices are likely to remain. They're still likely to be more upside from where they are now, and I think CEC, the copper company, will benefit. But generally, the Zambian economy, mining accounts for around about 20% of Zambia's GDP, and I think strong commodity prices, especially copper prices, will benefit Zambia, and we're quite optimistic. Liquidity is the biggest problem in Zambia, is that there isn't much trading that happens on that market. But if an investor is willing to be patient and to take a medium to longer term approach, there will be opportunities to be able to get into that market.